This conference will now be recorded.
Perfect. Cool. So how is everyone? We're here on September 11th, getting started with the first J&M podcast. It's going to be a little bit of a beta test here.
We're going to work through all the kinks kind of today and just kind of see how it goes. We have a general outline of what we want to talk about, and then we definitely want to do some of your viewer questions as well. But yeah, like Jumbo said, it's going to be a little beta test and see how everything goes.
So as far as podcast formats, we are going to create a little bit of variety based on what's trending. And so we're going to divide them into segments, and today's segments, we're going to be covering some recent news, some sentiment going forward into the weekend. And then we're also going to be starting off with our first Q&A session. We're going to be answering a couple of questions that were suggested to us by some of the VIP members. We also now have that channel set up in the Discord, so you guys can feel free to kind of message us over there. Add some suggestions, questions, anything of that nature that you want to see in future podcasts.
Yeah. So I guess we'll start off with some of the news. Actually, I was thinking we do, I don't know if you saw Wu-Tang Financial's question about doing like introductions, kind of giving our backstory, where we came from and our experience with options. So I think we should get started there.
Do you want to take it off?
Yeah, absolutely. So a lot of you guys know me as Simba. My name's Sanjan. My background educationally is from the University of Kentucky with economics and statistics. As far as employment background goes, I actually have never worked a fully financial analyst or even broker type job. Most of it's all in just manufacturing. Most of my experience is with supply chain analytics for automotive. What got me into options was just the ability to turn a small amount of money into a large amount of capital. So I got into it in 2016, jumped into penny stocks like pretty much everybody does, and that usually never ends well. So 2016 wasn't that good of a year. 2017 was kind of the same thing. I was trying to build equities and build a portfolio using shares and just more penny stocks. And then it wasn't until the first half of 2018 where I really discovered options and just the how quickly you can make money and how quickly you can lose money if you're wrong on your position is kind of what attracted me to it. So for the first half of that 2018 year, we took a couple hits, and then the second half I ended up hitting a little bit on that Tesla ER in July or June, and then that kind of got me trying to learn the technical side of trading. And then there was also the Beyond thing that was going on where they went parabolic. They were up to like 200. And then they started going back down to 130. I ended up shorting that, made a little bit of capital there. But it's been up and down for that entire year, up until December, where I really kind of took things off by joining J&M. Like once I joined the Discord, that's where I started doing really well. Some of the risk management that I was able to learn there, the overall entries, the exits, the chart analysis that we get posted every morning, a lot of that adds a ton of value to being a good trader.
I agree. I mean, we definitely have the resources here where we can supply accurate information to traders of any level. We can supply alerts, charts, analysis, and really anything that a trader would need to be successful. And so I think that's a really great benefit of this group that a lot of people have been able to take advantage of.
Oh, absolutely.
So I'll take the intro part here where I'm Chris. You might know me as Jumbo in the server. I'm trading on and off for a couple of years now. My background is in real estate. I do property management and real estate development throughout New York City, some of the extra boroughs. I really started to kind of fine tune in on trading about maybe 3 years ago. I'd say around 2018, 2017. As well, where there was a lot of opportunity in the market, and I only understood it from an equity perspective, from a traditional investing side of things. I did definitely have some experience as far as trading a little more proactively, but nothing to the extent that I've been able to learn today. And so I originally learned about options, I want to say in 2018. And then that was really where I kind of started to dive deeper into this and kind of see that it's something that's accessible not only to people with a large amount of capital, but also people who, might be on the newer end of things, people who were, you know, not previously knowledgeable about this opportunity. And that's something that really blew up in the Robinhood phase, in the Robinhood era, where people are kind of able to actually take advantage of the market. And so I think that's something that I really took the initiative on and kind of started to, dive a little deeper, because I realized that there are people who are self-trained and people who have experience just through, actual practice, through kind of learning, finding out their mistakes and starting to develop their trading experience. And that was something I was really keen about, where I kind of wanted to focus in on that. I'd say I joined the group, actually one of the first members here, and I had met Hovan prior to that in another group that a lot of people are familiar with, Pineapple, which we don't try to talk about a lot. But really, that was when I realized that you can, through the realm of technical analysis and through, sheer research, through actually taking the time to create a trading plan that works for you and, actually developing your trading abilities, that you can make this into something that's successful in the long term, something that has room for growth and, compounding growth across that. And that's when I really dove deep. Everything since then that I know, that I teach, that I practice, has all been self-taught, and it's only upward from there.
Oh, absolutely. And I mean, it is always fun to bag on Pineapple, but that is kind of where the majority of us got our start. We just took what he was doing and took it to a new level. Hovan's a significantly better trader. There's a lot that goes into it, such as far as trend analysis, momentum, swings, and I think the value that we get with J&M is definitely a couple levels above Pineapple, in my opinion.
Oh, 100%. I mean, I would like to say we're in a different league.
Oh, absolutely. So let me ask you a question. I know Wu-Tang mentioned it. If you had to pick some of your highest highs with trading and lowest lows, what do you think? What do you think those would be?
In terms of specific trades, specific times, or just in general?
Just in general, trades and times, or let's say the moment you knew that trading was going to be a thing you wanted to do full time.
Well, I think that really started off with about the same Tesla ER play. One of the jokes that I like to bring up pretty often was obviously back before I was a lot more involved in the day trading and trading as a profession. I had a order that I submitted on my Robinhood for a purchase of, I think it was 10 Tesla shares, and it was trading at around 275. And Tesla did not reach that price level, and I canceled my order. And I still have that canceled order in my phone favorite photos, because that's just a reminder of how much I didn't know in terms of possibility back then. I would say that's one of my lowest lows, and this is Tesla pre-split.
Yeah.
Keep that order up on my phone as a reminder of just patience, being able to understand a situation fully before reacting to it, and kind of using that to push myself as a trader as well. On the opposite side of that, I would say for highest highs was that ER play that a lot of people were able to create a very substantial amount of capital in a very short amount of time. And it was that point where it kind of clicked for me.
Mm-hmm.
Some other people, even for Hovan, an example, that was an opportunity where he was able to turn, $100 into 5 digits. And that was something that like blew my mind in terms of like what's possible. I also was able to, create a pretty substantial amount of capital from those trades, and it's kind of what created the foundation to my current accounts.
I completely understand. Speaking of ER plays, when you were talking about the highest highs there, I thought you were going to mention Amazon back in February when it had that crazy spike from like 1830 to 2055 the next day. That was definitely one of my highest highs. because I'll never forget that. It was on a Thursday. It was like 2 minutes till close, and I ended up throwing in $1,200 on like a 1930 or 1940 contract expiring the next day, just a random, ER YOLO. And then like a minute after close, it just exploded to 2,000, and I was just ecstatic with how much, because that's one of those plays where you turn 1,200 into 10K, essentially.
Exactly. And I think the funny thing back about that Amazon play specifically was, at the time, a lot of people in the group had been kind of chopped around by Amazon and kind of a little untrustworthy of playing that ER specifically. So I myself, as a product of kind of being messed around with that, I sold my calls at market close before that ER. And so
Did you really?
Yeah, I did. I'd missed out on that one. I definitely made some money on it, but not as much as if I held the following day.
Yeah, I know. The next day when I woke up, I was able to close it out for about 11 grand. And I mean, dude, I took the next week completely off of trading, and then I booked a vacation to Sydney, Australia for my 30th birthday. I was like, that's there we go.
Oh, okay.
Yeah, hopefully my camera doesn't go out like it did last time. I don't know what happened there.
All right. Well, we're back. I've been talking to a gray screen, but glad to see you back again.
Yeah, awesome. Glad to be back.
But yeah, no, that was an amazing opportunity. And I also think Beyond was another one that a lot of people kind of saw at the time when the group was more towards infancy.
Yeah. So one thing that we see a lot in the markets on a weekly, even daily basis is momentum plays. We're going to jump into it here on the news topic when we talk about NKLA, but once they IPO'd or that SPAC went through, they jumped up to $93 within a 2-day period. And then they had that GM news, pumped them up another 40%. And then that Hindenburg report came out and they tanked 25% over 2 days. So what's a way that we can look at to optimize those trades and capitalize on opportunities like that? I mean, do you FOMO in when you see high momentum, or do you kind of stay back a little bit?
Well, I think it's being able to understand what type of movement is happening and being able to distinguish between the potential for sustained momentum and that versus buying in at the top, right? And
Yeah.
so obviously something that you're going to be able to kind of distinguish depending on your ability to analyze the chart. And sometimes there are situations where you can't really figure out the extent of a potential move when you're looking at something that's going parabolic in a step that a lot of these do, such as Tesla, for example, on its initial run to 1,000. That was something that a lot of people were, kind of trying to short and creating additional short interest. If you bought in at the top at 1,000, you might have gotten absolutely messed up on any of your positions on the following pullback.
Yeah.
Now, you were able to hold through that to, the 2000s is something that, doesn't come easily for a lot of people.
Well, I mean, I think you also have to look at the financial side of the company itself. So when Tesla started its parabolic run, they had positive cash flow, they were marking EPS, they had high revenue. So financially, they were stable as a company. And then they were also pumping out products, they were expanding new gigafactories. I think the case with NKLA was a lot of that smoke and mirrors, because the reason that report kind of tanked them was it just stated facts. They've been around since 2016. They said they were going to drop the Badger initially in 2017, and then that kept getting pushed out and pushed out and pushed out. And then once you bring that to light, along with some of the battery challenges that they've been having, like I think the company that they partnered up with for their initial battery that was supposed to outperform Tesla, for whatever reason, I think the company went bankrupt, and then they ended up losing that partnership. So then when they got the GM contract, I believe they're actually using GM's fuel cells to power their vehicles, but they never outright stated that initial deal, went south. I think if they had that type of transparency, then a lot of these pumps would be more genuine, They wouldn't seem as.
And I think some of the issue there is a lot of retail traders trying to trade Nikola into something that it's not, right? And so a lot of the sentiment there, calling it the second coming of Tesla, seeing Tesla's successful parabolic run, successful performance, a lot of its recent momentum, and that tended to kind of transition over to Nikola, where people expected something similar. And so, just as we saw a very tremendous parabolic run in Nikola, we're going to see a very strong drop there, simply because there's no reason to have, investments, a company valued at that much, at that price point.
Oh yeah, absolutely. I mean, the fundamentals aren't there financially for the company, and you're essentially basing that entire 14 billion valuation just based on the possibility that they might be the next, Tesla. More likely, they're going to end up being sort of like a Neo, and I think they're going to level out at that $20 range before they fade away.
Right.
Yeah, but that's one of those things where you have to be really careful in the market, just jumping on any sort of momentum. If you're going to jump on the momentum train, like even when Beyond was going parabolic, they were coming out with deals every day. Things were looking up for them. So before you jump into a play like that, you want to look at the entire aspect of the company that you're investing in.
Completely. And, when it comes to trading for value versus trading for FOMO, a lot of these companies are getting valuations that might not necessarily line up with the numbers that they're putting out. And so for a long time, Beyond had such, a high short interest, and also it was such a volatile, stock to trade, specifically because of the fact that it was just getting pumped up and then dropped down repeatedly.
Mm-hmm. Yeah, I definitely agree with you on that. But I was wondering if you wanted to move on and kind of talk about next week and what we can sort of expect to see. Because this week we were pretty much range bound on the S&P. Just a lot of chop, and then any decent pops that we got were all shorted. So I am surprised that happened this week, because I know coming into the week I was very bullish. I was expecting a hard pump after the sell-off pre-holiday. So hopefully we get a little bit of that next week. What do you think?
I think so as well. Obviously, we had a very strong movement towards close, where we kind of bounced off of our 333 level and moved a little higher. I'm interested to see how we open and how futures open over the weekend. And I think, provided that we kind of are able to break out of this range, that's something where we can kind of see some more movement into next week towards the back half. Anything that happens on Monday, I have a strong opinion that we're going to kind of need to see it settle down, need to see where our daily candle close on Monday before we can, finally determine some upcoming movement. And so we do have some price targets, and also in the wider scope of things, there's a lot of other things to be considering as far as the economy, the recovery, COVID, and also kind of factoring that into specifically what's happening right now. So, one of the terms that's being tossed around a lot, one of the things that we're seeing is the reference of a K recovery, right? Where we hear people specifically mentioning that what originally was a V recovery is now a K recovery. And what does that look like? Well, it's something where we are initially being driven back up very rapidly by a lot of the large cap tech stocks. And that's providing the majority of the momentum, where we've seen, Apple basically taking on the brunt of it and moving tremendously in a very short period of time. And so we're seeing that now reach a level where a pullback is due. And we're also on top of that experiencing a lot of economic turmoil in some of the smaller cap, in some of the traditional value stocks. And that's going to be part of our pullback, where we're kind of getting this, transition from tech over to other sectors. And that's kind of hurting our momentum here, right? And so that's the K recovery that a lot of people are referring to is, how far does this leg down actually take us?
I would look for that 330 base to see the pump, because I mean we're getting pretty close with 331, 330. I don't think it's going to go below that unless we see, a stimulus package delayed again. I know those negotiations just failed, But I don't really see any reason for the overall market to go down. Tech should go down a little bit just because we can all agree that it's overvalued. It's been significantly pumped since COVID. And they've profited from COVID due to, you don't have to be in the office to produce those types of products or services. What I would like to see is just a transition or a sector rotation out of tech and more into some of the financials and banks, because with the Fed controlling interest rates and inflation as they are right now, I don't think there's much overall concern with the economy. I mean, COVID is not going to last forever, right? The U.S. economy isn't declining. If you look in my area, you can still see that companies are hiring, they're trying to expand, they're trying to blow up again. They had that initial layoff, but I think now a lot of companies are benefiting from it. You're lowering your operating expenses, you don't have as many employees, so there's definite room for growth. As far as how that translates into the market, since a lot of the time, actual economic factors aren't represented, that will probably take some time. But I think once we see a solid sector rotation out of tech, we can get new all-time highs again.
Precisely, right. And so it's really a matter of how long does this current pullback last? How long until it takes that sector rotation to actually begin to see an increase in the value in some of these companies, an increase in the price action, and is it going to be enough to kind of trend us back up to there with tech taking a breather right now? I don't know, but definitely, in the very interim, in the short term, I don't think tech can lead the race anymore. And so we do need some more movement from some of the other sectors.
I think once retail really starts opening up again and travel, I think that'll probably be the sector that takes over. Because, I mean, we saw it with Ulta, and then we saw it with Lululemon as well, where even though same store sales have declined, their e-commerce sales are booming, So people want those products and the demand is there. I think once you get that initial push after stores fully open again, I think that's where we're going to start seeing a lot of the gains.
I agree. And so then, as far as expectations for next week, provided we continue this upward momentum on Monday, what kind of targets do you think we're looking at? What kind of range are we specifically paying attention to here?
Oh, personally for me, if I'm looking at the S&P, I am not fully bullish until we get back above 342. That's generally where I felt fairly safe in making my overnight calls. But I wouldn't really try to trade anything overnight. I think a strategy that works for me that's continued to work is just scalping the opportunities and capitalizing on a day-to-day basis. For example, we saw that SPY hit 331 today, and I grabbed some 332 same-day calls looking for that initial bounce, and it was there. So I think if you're trying to stay profitable in this market, you shouldn't be looking at 100% or 200% or hitting 1,000. Look for that safe 20-30% margin per trade, and then you have more funds to trade with the next day. So your account is growing, and then you're also managing your risk. I think that's where we need to be until we get full confirmation that the market is strong, or until we have a confirmed sector rotation.
Right, and I think that's one of the things that Jovan has been talking about specifically, where the 2K challenge, some of the members with smaller accounts are going to have difficulty trading when our volatility is a little higher, specifically because we need to be making shorter, stronger movements, taking advantage of those, and then from there, we can kind of start to ease back into the longer term trades, some of our more traditional swing trades, kind of want to start to, regulate themselves. And so as far as targets, I'm also really looking at that 342 level. Even before we get there, 338 is going to be a level of interest. And then also below that, we have this range on this zone about 336 that we're looking at. And it's that $2 movement that would make me feel pretty comfortable. And obviously, of course, any movement in VIX being, able to corroborate that strength to the upside.
Absolutely. I think for next week we should see some solid bounces in the S&P. I think it's actually going to be led by Apple. I know that sell-off today was pretty brutal. We opened up at 115 and then just faded all the way down to 110. I think it is due for a bounce. Usually when we see significant red on the daily candle like that, I always look for at least a 30% retracement within a 2 to 3 day window after that initial drop. I don't think the economic conditions that we're currently in is going to, lead Apple to drop 20, 30 points in 2, 3 days. So I think if you are looking to swing some calls over the weekend, or if you are already in them, I think you should be okay for the first couple days of next week.
Right. And so I know you mentioned that you actually entered some 332 SPY calls. I actually saw that earlier today.
Yeah.
Were there any other positions that you were kind of looking at over the weekend into Monday as far as opportunities?
As far as opportunities go, I really like AMD to touch 80 next week again. I was hoping that would be today, but that didn't really go my way, so I lost a little bit on that same day expiry. But swinging it for next week, I do feel comfortable with AMD at least hitting 79.80 again.
Right. No, definitely. I think AMD got a little beat up, and so we can see some movement there. I'm looking at Apple as well. Tesla kind of had a strong retracement later this afternoon, so kind of going to see where we open in on there. Tesla's still a little range bound, and so I would like to see us higher, retest at the 390s on Tesla, and then really from there, my next target would be in the low 400s. I have a level here at around 403 that I'm looking at, and so I did actually swing a couple of Tesla calls into close.
Very nice.
Monday. I had some Apple positions. I closed out a majority earlier today, and so I am also looking at Apple for Monday. And also Microsoft. I ended up entering a few positions there as well, just because it held pretty level, and I'm kind of interested in seeing a little bit of a rebound there on Monday. See if we get some stronger movement in the tech.
As far as have you heard any updates on that TikTok deal with Microsoft and Walmart? Has that fallen through completely, or is there still any opportunity there?
No, and you know what? I haven't heard any updates, but I do know that China specifically is kind of pushing back on the deal. And so some headlines did come out today about how, they were refusing to let TikTok at all be sold out. And, a lot of that has to do with the IP specifically that China wants to maintain control over.
Yeah.
And how that would factor into the sale of any US assets of TikTok. And so I think that's something that's going to be a little difficult to negotiate. And so for right now, I'm kind of not factoring that really into any movement on Microsoft until we see any kind of sentiment change or any kind of update as far as China taking a hard stance on that sale.
I know right now, or the latest news that I saw from Trump was that he's not extending that sale deadline. So that's coming up on the 18th. So I'm really curious if the sale doesn't go through, what a lot of these companies are going to feel that have, talked about merging and buying TikTok.
Right. And we're definitely going to see some volatility leading up to that in some of these companies that are more heavily invested. Specifically, I do think there are some that are going to be, a little more affected as far as price value than others. I do expect Microsoft, if we weren't able to get this sale, to have a pullback, and we might even dip below the 200 level. But Walmart's something that I would look at to kind of gauge specifically what kind of movement we could have on Walmart, and if that's something that's worth trading in anticipation of more TikTok news.
As far as a weekly basis on trading Walmart and Microsoft, I mean, you're welcome to jump in on the volatility and trade, but both of those companies are actually very strong and financially stable. So if you want to add those to your portfolio, even at these levels, I mean, I think they're solid holds for the long term.
Oh, of course. And this sale has nothing to the larger value of both of these cap stocks. And I would expect them both to also continue in our rebound here. If we do have some bullish momentum in the market, we can't see upside to both of them, regardless of that, any short-term effect that the TikTok sale might have on us.
I'm with you there. So it looks like we got a couple questions in the chat. Do you wanna start tackling some of these? Because I know we had planned for only 30 minutes and we've gone over just on introductions and news alone.
Well, I think specifically we did have some questions and answers that some of our VIP members kind of discussed with us yesterday. And I
Yeah.
would like to focus on some of those tackled. And I would say for anyone whose questions weren't necessarily answered today or touched upon, if there's something that you would kind of like us to dive into on the next podcast, definitely feel free to ask a follow-up question. Take advantage of that channel. And aside from that, outside of the podcast format, I would say Simba and myself are, pretty active in the server and regularly available. So also, feel free to ask us any questions there if it's something that you don't could wait till next Friday if you want to kind of reach out and get our opinion on something.
Yeah, absolutely. I mean, the reason that the podcast was started is just supplemental information and entertainment for you guys. So we're all traders. We're all trying to grow our accounts every day. If you see something that we don't see, that might open up opportunities for us, and then we might be able to answer questions that you're having, and then we all end up being profitable together, which is the ultimate goal, you know?
Absolutely. So then I guess moving on to our questions and answers section, we have some topics, and actually we had a couple of variations of the same question. So we had a lot of people asking us about hedging specifically, a strategy that was going to be very helpful during recent movement, and also a strategy that a lot of people don't really understand to deeper level, or don't really know how to implement these different strategies in their accounts.
So as far as hedges go, from my perspective, looking into the overall market heading into a certain trading day or a trading week, I look to see if if personally I am bullish or bearish on the week. You know, if I'm thinking that the market is going to go strong this week and I'm going to spend the majority of my time looking into bullish options, I will buy put hedges usually on VIX or on SPY, depending on what I'm trading. Sometimes Apple is a good put hedge as well. A few weeks out to kind of negate the loss that I may take in the short term. So usually my put hedges are always a few weeks out and they have time on them. I try to buy slightly in the money, just so I'm sort of guaranteed. I'm not looking for that initial volatile boost to give me, 500%, but to have steady gains as my calls go up or go down. What about you?
Right. And I think that's definitely a good strategy if you intend to swing some positions where you need something a little more stable against positions that you might have more in capital invested to, some larger positions in your account where you might have something that, really your risk is pretty limited to the downside. And so you can't, hold those naked positions multiple days. I think that's a fine strategy. Specifically, and this kind of ties into one of the specific questions a member had, and their question was, how do you determine how much to hedge, and when, let me see, what time should you sell your hedges?
Yeah.
I think that's something that we can touch a little bit upon. Obviously, from a traditional standpoint, your hedge is going to serve as a limit to your downside risk, right? And it's going to function against limiting your loss during unexpected movement, right? And so really, any movement that's outside of your predefined risk in the trade can be benefited by having hedge. And so one of those scenarios that I tend to kind of gravitate towards is I will offset any short-term risk to my positions, especially if I intend to swing on a longer position. And so what that might look like is I'm getting shorter term with less cap requirements in my account specifically, so that I can function against or protect against immediate losses or immediate downside movement on a day-to-day basis, while kind of securing and protecting some of those longer term calls in my account. And so I actually think that functions a little bit on the inverse side of things as opposed to your mentality towards trading, where they really have the same effect depending on the positions in your account.
So as far as letting your hedges expire, how do you manage your exit cost or exit plan on your hedges. Because my strategy usually is, or the way I like to think about it is, if I'm swinging calls for the week and I have a couple puts a few weeks out, I look to increase my profits for the week enough to offset 100% loss on the hedge. You know, if
Absolutely.
if I'm 3-to-1 calls to puts, I'm hoping that what I gain on the calls completely offsets the put and I don't have to worry about it. Because, you don't want to sell if you're minus 80, 90% and you still have time on it. You want to leave it and just have it as a lotto.
Right. And so one of those things is that, do you let a hedge run its course
Mhm.
and gradually, either increase or decrease new positions, new hedge positions, right? Or on the flip side of that, do you take short-term, movements in the hedge and use any profits from those to kind of offset those losses, right? And so that's something that I tend to focus on a little more, where any short-term profit on the hedge, anytime my hedge succeeds in its initial function, which is to protect my account, then
Yeah.
I tend to reassess the position as a whole. And I also would factor that offset by the hedge into my cost basis for the trade. And so by guaranteeing that profit from the hedge, right? If your hedge is succeeding and you're experiencing some downside on your calls,
Yeah.
I would rather take that money off the table on the hedge and then hold my calls onto the, trend change, hold my calls into the bounce back, or hold my
Yeah.
calls into any type of upward movement after already securing, that offset on my cost basis.
It also opens up the door for you to roll your hedges. Just because you're up doesn't mean you have to close out the position and just sit on the cash. If you're confident that, hey, I think the market's going to go this way for a little bit longer, you can roll out for a further timeline, still have that initial money plus the gains to hedge you over for a longer period. And then you can continue with whatever weekly strategy we're employing.
Absolutely, absolutely. And this is why you'll see a lot of times, you know, in the official trade alerts, that we will have a lot of contracts that we're holding, almost to zero value, almost to worthlessness, because of any potential chance in rebound in those. But generally, a lot of those contracts are being offset by intraday profits, by day-to-day movements, where
Yeah.
you can actually afford to let those positions go to zero, like you said.
It's one of those things too. Like, there's nothing more frustrating than selling out of a position that was, minus 85%, and then 2 days later it goes in the money. Like, that's one of those
Absolutely.
things where you would just kick yourself. You're like, oh God, why did I do that?
Right? Or you take something at a loss and then you see it go back to break even shortly
Yeah.
afterwards. Well, really depends on the positions in your account and your standings and your, risk tolerance. And that's something that, can't be a set answer for everyone, but, is really determinant on how you feel about the position, what kind of profits you've been taking in recently, and what kind of risk you can afford to tolerate.
That's kind of the way I see it as well. Risk management is a huge part of trading. My strategy going into trading is whatever option, contract, or even equity that I'm buying, I assume that as soon as I make that purchase, that money is no longer on the table for me. If it's going to be a make or break situation for me, then I wouldn't be investing it into options. So you have to
Right.
understand that that emotional break from the capital that you're using will initially be difficult to do, but it'll guide your success. If you're not attached to that position, you can let it go, minus 50% and then hold it overnight, and next day it might go up. But at the same time, you have to be able to realize when a position is not going your way. I feel like a lot of new traders hop into the, well, it's not going well right now, but I'm going to average down on my position, and then soon it'll go back up. But 90% of the time, when you end up averaging down, you just end up losing more money.
Well, right. And so to touch upon averaging down, think about it this way. Anytime you're going to engage in a trade, right, you obviously have your trading plan, which would be step number one. And if you don't, then that's something that you need to work on as a habit. And within that, you have a predetermination for the expected movement in the stock that you're trading, right? You have a expectation for what kind of downside, and you're prepared for that. And so in your trade, when you initially engage in the trade, you should already have set apart or set aside the total amount of capital you're willing to initiate into this trade. And with that, obviously have your stop loss and your take profit. Anytime you try to average down, you're exposing an additional amount of the capital in your account previous to the amount you already agreed to set aside. And so, if I say I'm going to put $1,000 on, calls in a specific ticker, I start to, kind of engage in a loss. I'm down at maybe $800, $200 loss there. And I'm saying, you know what? Okay, I can actually buy a few more calls and let me put another $400 in. It's just a bad habit because not only is it cyclical and, kind of trying to offset losses by increasing risk.
Yeah.
And that's not, strategy that you can use day to day. It's not going to work.
One thing I know we saw a question about it in the Discord was, what's one thing that you guys know now that you had wish you knew when you first started trading? And I think this is one that we should definitely hit, because for me, it's having an entry plan and an exit plan. What I do now is I set certain margins on a trade that I am comfortable taking. If I set my margin for the week to be at 25%, no matter how confident I am in the position, I am going to lock in that 25%. I'm done for the day, not going to overtrade, and the next day I'm going to try to do it again. That's something that I wish I had known a long time ago. Also, with knowing when to exit a trade, if you see that you're not using a lot of capital for your trades, or you have minimal amount of money you can trade with, be strict on how you set your stop losses. If you're down 30% and that 30% is 30% of your whole trading account, you don't want to let it get to that point. You want to cut it way beforehand. Which kind of touches back into the whole don't average down on a losing position, manage your risk, and don't jump into certain options that are extremely volatile. Like, everyone likes to trade Tesla because it's fun, it's a money maker. I mean, it can gap up 80 points overnight. But how likely is it that it does that every day? You're risking $2,500 for a small chance that it gaps up exponentially overnight given the greater market. So knowing how to separate the risk from those types of trades is good knowledge, I think.
Absolutely. And that's something that comes with practice, but it's also something that we try to teach a lot of the newer members. And so one of the things that you'll see, if you're following on that small account challenge, if you're following those alerts, is rarely is the entire capital of the account invested at one time.
Mm-hmm.
And rarely are those positions, costing more than 10% of the entire capital. That's, not something that's going to be explained every single time a position is entered or exited, but it is something that we practice, and it's something that, if you're watching Jovan do it, is going to be done time and time again, according to his risk management, according to his, exposure. And a thing to kind of think about is, if you have a trade where you are putting aside, I think the standard number a lot of people like to throw out is 10%, right? You never want to be more than 10% of your entire account in a single trade. If you're practicing proper risk management and you experience a loss in that position, that loss is just 30% of 10%, right? And so losses tend to be very small if you're actually, paying attention to your limitations.
I completely agree.
Yeah, and so, to kind of piggyback off of that, I would say one of the things I wish that I had first learned when I started trading was that you don't need to trade every single day, and you also don't need to profit every single day, right? Sometimes a lot of people will set a specific number in their head and they say, I need to make $100 a day, or I need to make $200 a day, or maybe that number's higher if you have a large account. Maybe you're saying I need to make $1,000 a day, whatever that number might be for you. And if you don't meet that goal, you don't want to overtrade. You don't want to force something that's not there, right?
Oh, completely. So I can actually touch on that as well. If you set goals to where, hey, I need to make $200 a day, and that's going to get me to where I'm going to be comfortable for the week, what that is going to lead to is instead of capitalizing on the actual opportunities that are there for the day, you are going to self-affirm. You're going to find opportunities and justify them to yourself that, hey, this will make money, when in reality that setup was never there, you know? And
Absolutely.
you fall into that sense of, well, you know, it's going to go up because of this, this, and this. But reality for the week says, hey, you know, there's no volume here. The RSI doesn't confirm your position. The SMA lines aren't where they need to be to confirm the trend that you're trying to follow. But you'll look at other indicators that happen to justify that side. So it's very important to only capitalize on what's actually in front of you.
Absolutely, I agree. And so I'm seeing one of the questions that we just got was, do you set a stop loss right after placing a order, right after placing a trade? And for me personally, no, I don't tend to use stop orders that often, but I will mentally calculate what my risk in the trade is, what my limit for risk is, and I will know that number ahead of time. And so I don't necessarily need to place a stop loss order if I already am sticking to my trading plan and have a predefined risk.
I'm essentially on the same boat right there. As far as setting a stop loss, I will rarely set one. I don't try to carry too many positions into whatever trading day, you know, I'm on. I'll look at one or two opportunities, and I rarely watch more than 5 or 6 tickers at a time. So most of the time I can manage my stop losses. And like you were saying, when I go into a trade, I know the level that I'm comfortable with losing before selling out. Like today, when I had that AMD order, once it dropped below 78, I was like, oh, this is over. I might as well just sell out here. You know, I didn't
Yeah,
need a stop loss for that. But
right. And
sometimes,
you
go
were
ahead.
comfortable in that loss in the first place, right?
Yeah,
Absolutely.
it's just you have to understand what your risk management is before you even get to the part of buying the contract. Yeah, a stop loss can help you because maybe you have errands to run for the day and you're comfortable with this level, and selling at that level. But most of the time, if you're not over leveraged on positions and you're not playing same day calls or anything, you can generally manage the risk yourself, which is another point that I think is really good. I think it's good to not have too many tickers on your watch list, because then you're going to miss the opportunities that you know certain patterns are on. Like Tesla example for today, when we saw the initial dip down to 362, I think, 375 was about a 30% retracement from the opening high. So I knew that we were going to get back there at some point today. But that was one of the few tickers that I looked at. You know, if I had looked at 5 or 10 or 25, I may have not been able to analyze that chart properly. So you want to limit what you're looking at and try to capitalize on opportunities that you know are there. Because certain tickers have certain patterns throughout the week. Like we all know that Amazon generally sells off on Fridays, right? That's one of the things that you'd want to focus on. Make a trading plan for that, and then just capitalize on it when the opportunity's there.
Absolutely, absolutely. And so I almost want to say, this is something that there seems to be a lot of interest in. And, maybe even for next week's podcast, we can kind of do a more deep dive into how we specifically create our trading plans and manage those. Because I think there's a lot of insight, there's a lot of valuable information that, you can provide and we can provide to some of these newer members who are trying to develop plans for themselves.
Oh, absolutely. I think that'd be a good topic to touch on next Friday. And I swear to God, guys, I'm going to get my camera fixed, and I'll be able to get that going as well.
Absolutely. Now, I want to move on from the hedging questions. We had another question specifically about how to avoid playing high IV or how to avoid getting, tossed around by high IV. And so I think
Yeah.
this would be a good opportunity to kind of segue into that next question. So specifically, I remember Swami, he was asking, how are you able to determine if the premium for a specific option is overvalued for the ticker that you're looking at? And also, how are you able to determine when the implied volatility for a specific ticker is too high or, too volatile for you to actually trade? And I think this
So
is a really good question for, a lot of different reasons, because there's a lot of
yeah,
answers to that.
most definitely. One thing that this is probably the most simplest form of advice that you can give on this, but it works for me, and I'm sure your take's going to be a lot more technical. What I look at, if let's say market opens and overnight Tesla has dropped 100 points, and right out of the opening it's dropped another 10. At that point, I am not going to buy puts. They are already juiced, and the first thing I would look at is support and resistance for a possible bounce to play the opposite side, because those are going to be undervalued because all the IV's flowing to the put side.
So what you're
And
kind of saying is,
yeah,
when you have that, overvalued premium, it's priced accordingly because of the fact of the already strong movement that's happened, right? And so,
yeah,
I think we need to remember is that there's two sides to every trade. And, premium sellers are going to try and push higher and higher premiums, especially after a strong movement, like you just mentioned.
yeah, yeah, absolutely. So I would only jump into a position like that if you have hindsight 2020 or foresight 2020, and you can predict that the ticker is going to continue to move down in your direction.
Right.
Because if you do buy a contract that has high IV and the premium is just completely juiced, let's say that it doesn't continue to go down, it just doesn't go anywhere, it just hits a range bound level and just chops all day. You're going to be losing money at a much higher rate than you normally would because all the Greeks are also inflated.
Precisely. And so I think that's one of the things that I wanted to touch upon specifically for a more technical side to this answer. And it's, you want to look at the Greeks for the specific option that you're trading, right? And
Yeah.
so there's a couple different ways that you can kind of determine whether the premium value is justified. And one of those being taking an analysis of the delta and theta for that specific contract, right? You want to pay attention to that delta theta ratio because it's going to give you a little insight into not only how the contract has moved, but how it will move on any upcoming price action. So I think paying attention to the Greeks is going to be a very valuable thing when it comes to kind of being able to understand how a specific contract is not only priced, but where its potential for additional value could come from.
Yeah, I believe I answered this question in the Discord a couple days ago. I can't remember who asked, but what you're kind of looking at when you buy a contract is, yeah, the theta is the value that you're going to lose per day on your contract value if the price action is negligible, right? So then you want to look at your delta value, and ideally, depending on your budget, you want to buy contracts that have a high delta. The closer to the value one is, the better the contract is, because that's how responsive the contract value's price is to a $1 change in the security price.
Precisely.
Ideally, you'd want a high level delta with low theta on a security where the premium is not, jacked up completely, which is very difficult to find. I mean, if you're trading any of the big caps, all the premiums are jacked 24/7.
Absolutely. And so to expand on that from a little bit of a more technical perspective, if you're looking into specific ratios in that relationship, one of the things you want to understand is the implied trading range for the stock that you're looking at for the ticker
Yeah.
and where that strike lies on your chain in comparison to that ratio. And I'll give you an example. If the delta theta ratio of any specific option is a quarter, right?
Mhm.
Where we have a 1 to 4 delta to theta value. What that might look like is, a delta of 30 cents on a contract and a theta of $1.20, right?
Yeah.
Where we're going to be losing 4 times as much theta as we are gaining to delta and $1 movement. Automatically, we have priced into that a $4 movement per day. And so that $4 movement is going to carry over into your implied trading range. The premium is going to be adjusted. It's going to either be inflated or, trading slightly above value. And then you're going to have to see, well, how possible is it that we can actually reach the upper limit of that trading range? Specifically, a quarter ratio there where you have that, 30 cents to $1.20 is implying that in 2 days, that ticker needs to move $8.
Yeah.
Just for you to maintain the value that's currently being pumped into your contract. And so if you're buying a contract with a high extrinsic value, you're setting yourself up for a loss if you can't maintain the same standards, the same momentum that created that pumped value in the first place. If momentum starts to die down on the movement, and I think like the example you said where, the stock kind of plummets and you're expecting a bounce.
Yeah.
If it doesn't continue plummeting, if that momentum doesn't maintain, you're going to lose extrinsic value in that contract.
Oh, absolutely. Like what that really ties into is what a lot of new traders will do is where they will play earnings calls and not knowing what the implied move is. So
Absolutely.
when you're headed into an earnings week, the MMs have already priced those contracts to include an expected move. So no matter how positive the ER is, or let's say they beat EPS, revenue, whatever it is, if it doesn't cross over that threshold that the price was implied to rise by, you're going to get crushed. I mean, that is what IV crush is. If the expected move overnight is 20 points and it only moves 15, you might be in the money, but your contract will actually be worth less than it was when you bought it.
Right, absolutely. And so, I think that would be a good point. How do we determine if an IV is in fact high? And obviously we'll understand that while, oftentimes a very valuable strategy can be playing stocks up to earnings and playing that IV expansion, playing that upward movement in anticipation of an earnings report. Well, you want to always avoid IV crush as much as possible, but outside of the earnings report scenario, there's IV fluctuations depending on price action. So how do you want to combat that, or how do you want to, be able to accurately assess that? And so that's kind of where IV rank comes into play.
Mm-hmm.
And so specifically, IV rank is going to be the value of IV, the implied volatility, calculated over the highest and lowest levels over a 52-week time period. And so what you're looking at is what the absolute max of this IV has been historically in the past trailing 52 weeks, and then what the absolute lowest it has been. And then you're generating a number based off of where the IV is currently at in comparison to that difference. And so that's going to be able to give you a little more insight into being able to determine, well, is this IV relatively high or low over the last 52 weeks? And that's something that you can access on any of your trading platforms.
Yeah.
Specifically in Thinkorswim, IV rank is going to be called IV percentile.
Yep.
And while IV percentile is technically something different, where you're calculating that percentage move, IV rank is going to be that number that you can get in the IV percentile column. And that's something that you can add to your watch list as a study on the watch list. You can add it there, you can add it to your charts, and you can be able to pay attention to, whether that IV is high or not.
That was actually a really good segue there. So as far as indicators and adding it to your platform, what are the top 3 to 5 indicators you focus on while trading?
So for myself personally, I tend to chart a lot on one of the, okay, so that is a good segue.
Yeah, that was actually pretty nice.
Right, and so one of the things I like to teach in the technical analysis classes is confirmation and context, right? We might have confirmation on our analysis, but without proper context, we cannot make a determination of upcoming movement. And so what that would look like on a very basic level is, let's say you're paying attention to a SMA
Mm-hmm.
and you're looking for a bounce off the SMA. SPY, for example, bounced off the 50.
Yep.
That bounce, while it is your expectation for a rebound, right? Your approach to that level, you really need to wait for the additional context, right? You would either need to wait for a confirmation from your momentum or confirmation from your volume or something else on your chart that's going to indicate to you that that movement is confirmed, right? So that you don't fall for a dead cat bounce or so that you don't fall for, something. And so specifically, some of the things that I definitely use, I always use my TTM squeeze. I tend to use my Fibonacci level retracements pretty often, pivot points, any type of supply and demand zone that I can chart very quickly is something that I'm going to look at because it's going to give you a little insight into expectations for volume. And all of those strategies, all of those different studies that I just mentioned are really a combination of that context and confirmation, where you're kind of waiting for compounding sources of information to give you like multiple green lights, right? You want to check off multiple boxes before you really move into a trade, before you really jump in on a trade.
That is very true. When I first started looking at indicators, I fell into that trap that new traders jump into where it's over information, just an overload, So I would be looking at my SMA lines and, the basic pattern is if your short-term SMA line crosses over the long-term, you have the golden cross setting up, you're looking at a bullish pattern. But then I wouldn't set up my RSI correctly, so my RSI would be sending me the opposite signal. And then it would kind of leave me confused, which kind of goes into what you were saying about you want to have multiple green lights before you jump into a position. So for me, what I try looking at is the SMA lines, the RSI, and then as far as option contracts go, I do put a lot of stock into open interest and volume on a specific option contract. Given the amount of open interest, and especially if that ticker is seeing significantly higher volume for that day or for that week, I'm more than likely going to follow along on that type of trade. Usually if there's that much, I mean, we thought we were going to see it with Apple this week with all those 120 calls, but that didn't work out for those investors. But a lot of the time, if you do use your indicators along with open interest and volume on the overall security, it can lead to a profitable position.
Right. And that's something where you're kind of touching a little bit about, being able to understand how flow works, being able to pay a little more attention to larger interests in different contracts and how those might affect the pricing of those contracts and also be indicators towards upcoming or future movement.
Yeah.
That's that on a very basic level, that's information that we provide to members in the form of the sweeps channels, the flow channels, some of the prints that are, added. Those are all levels that you can kind of look at, trade upon, all of signals. But really, it's definitely something that you can expand upon and create a very profitable strategy just by understanding how flow works.
Yeah, no, I completely agree. Let's see what else we have in here. Do you use the default RSI and other indicators? What SMAs, EMAs, and what time frames do you like to trade on? So as far as the time frames I like to trade on, I like to look at the 1 and 15-minute time frames if I'm scalping. If I'm looking for a longer term, I'll just look at the daily. But those are mostly positions that I'm going to hold for a longer bit of time.
Right. And one of the things to expand upon that as far as time frames from a technical perspective is analysis across multiple time frames, right? And so if you are trying to predict movement outside of a day trade, outside of a scalp, you want to look at multiple time frames to gain an idea of upcoming movement and also the timeline for your expectations in that movement, right? So you chart a bull flag on the 15-minute, but you need to cross-reference that with the hourly or the daily especially if it's a trade that you intend to swing. As far as SMAs, the 50 I know is one, and the 200 are going to be two of the most popular SMAs that a lot of people use. You can use some of the shorter term SMAs to kind of give you a little more insight, but for any of the short term SMAs, that's where I tend to transition over to the EMAs. And so those are obviously going to have much faster movement, much more quick reactions to price changes, and you're able to use those to gauge momentum pretty fairly, whether those lines are being held across your time period. And so some of the common EMAs, the ones specifically that I have on my chart, are going to be the 8 time period, the 21 time period, the 34 time period, and then also the 89. And having all 4 of those on your chart are going to be able to give you a little more insight specifically for shorter term trades, for anything where you're looking on that quicker movement to really, either justify or sustain a trade on a short-term time scale.
I completely agree with you. Do you wanna take this next one on VWAP?
Yeah, so VWAP. VWAP is the volume weighted average price. We actually, I think, had another member ask about VWAP earlier today as well and how we use that. So VWAP specifically is going to be calculated fresh every day, and it's going to continually weigh the average price of the stock throughout the day, based off of the volume as well. And so it's going to be weighted towards an average line. And the way this works is that generally the stock tends to converge towards VWAP. It tends to maintain that average. And one of the ways you might see this work is, if the stock starts to diverge away from VWAP, you might be able to obtain an expectation that it might trend back towards it. And any cross over the VWAP would help you to identify strong, sharp movement and strength in volume. VWAP isn't something that I tend to pay a lot of attention to. I tend to trust some of the other price levels that I chart manually, but it is good as a trend confirmation tool where you can kind of say, as long as we're above the average price throughout the day, as long as we're above our VWAP throughout the day, I can be confident in remaining long in the underlying. Or in the inverse, if it's underneath VWAP, maybe I can feel comfortable being short a position there. Like I said, VWAP isn't something that I would use on its own to enter a trade. I tend to look at multiple sources.
Yes, one of the things that I think is critical for any new trader is fully understanding support and resistance. That's kind of been my bread and butter for my trading career, especially with scalps and playing range bound weeks like we had this week. Always look to capitalize on if a security is getting close to support, and you've seen it on the minute, the 15, or even the 1-day chart that you're looking for that bounce. If it's done it, 5 times in a row, chances are that it's going to do it again and bounce, unless there's an external catalyst in regards to news. But this kind of leads into any insight on gap fills. So my opinion on gap fills, all gaps will be filled at some point or later. It's the trend that I think we've seen and continue to see. Looking at one specifically that some of our members profited on was Zoom. Zoom had a massive 150-point run after earnings, and then slowly it looks like it's heading towards filling that gap. CRM is another one. There's definitely a couple out there. So always keep in mind that it may not happen this week, that the gap gets filled on a certain security, but it could happen if the right conditions are there and the overall market is heading downwards. That's why you don't want to have companies that are trading at 120 times forward P/E during any sort of market volatility. Those are the first companies that are going to lose value. They're all based on growth, and 90% of the time they have significant gaps. Like we talked at the start of the show, you saw it with Beyond in 2018. They were getting a new partnership like every day, and they went from $80 to 216 or just something ridiculous. And then slowly over time, all those gaps got filled and came all the way down to $50 at one point, I think.
Mhm. Now, the one thing to expand on that specifically is that I would not use the existence of a gap fill as the creation or initiation point for a trade, right? And
Yep.
because oftentimes what we'll see is that, a lot of times stocks will tend to gap fill just so that it's been completed and then trend in the opposite direction. And so, a lot of people will kind of see a stock approaching a gap and obtain an expectation. Let's say that gap is to the downside, and
Yeah.
they might want to enter puts for a very short-term trade. But really, we've seen plenty of times over and over again where that gap will get filled and immediately a rebound will occur. And so, I wouldn't engage in a trade just purely off the existence of a gap fill, but I
Yeah.
will keep that in mind, going on any other trades that I've already been in. So if I'm in a trade where I can expect a gap fill to affect my position that I've already have, that's when I'll pay a little more attention to, the movement in price as we approach that area.
If you guys want to look at a ticker that kind of pretty much identifies exactly what we just talked about on gap fills, look at Sage Pharmaceuticals. I think they're trading at like 53, 54 right now with a high of 57. If you go back a couple months, there is a massive gap to the upside from the 57 range to 71. And the thing that makes that appealing is next Friday they have that JP&M conference call for some kind of new drug. So if you look at some of the open interest and volume in that case, you can see that a lot of traders are betting on the upside there. But like you were saying, how likely is it that it actually fills that gap? It could be a complete sell the news event and it goes completely flat. So you can't let gap fills trick you into confirming a position that you're already in. But if things are leading to support that, hey, this gap is likely to be filled, then it's something that you should kind of pay attention to.
I agree. It's always, like I said, it goes back to that idea of context and confirmation. You need both at the same time to really feel confident about your analysis. And so you wouldn't trade off any one signal, but you would pay attention to how a specific signal operates, or a specific price level operates in context of the whole.
Mm-hmm.
Now, as far as questions, I think we covered all of the ones in chat.
I believe so.
I'm trying to see if there's any other ones that we had in the VIP chat, any other members that had some questions for us. Here's a good one. We had one going back to hedging, talking about VXX versus SPY and when to use either or. And I also see a new question has just come in, also talking about tracking market identifiers. So I guess we can take a quick second, talk a little bit about that relationship between the two.
Yeah.
I'll take it off. So specifically for my, I'll start with your question about the Thinkorswim setup. I tend to rely upon my watch lists and also upon the different movements in any of the inverse. For example, SPY, which is an ETF, and VXX, which is an ETN. Looking at the inverse movement and whether there's a convergence or divergence between the two. So for example, I'll have different watch lists. I'll have my main watch list, maybe a high movers for the day watch list, and then also I'll have a market watch list where I'm able to keep track of these different indexes, futures, and all of those things. And I can swap between them very quickly using the quick watch list on the left side of your Thinkorswim, and kind of just able to, at a very quick glance, take a look at any of the ones that are there. And so I usually have mine in separate lists. That's how I would track them, is just manually, periodically switching between the two. recently, due to a lot of the shock that we've been experiencing, a lot of the range bound trading, and a lot of the movement in VIX, on my charting setup, I would have SPY and VIX charted next to each other so that I can pay attention to any movement in the two. Expanding on that, let's talk a little bit about VIX specifically. Like I mentioned, and I'm talking about VXX, not VIX. I'm talking about VXX.
Yeah.
And that's an exchange traded note. So it is a note. It doesn't hold any assets. It doesn't actually represent anything. It kind of works like a bond, and it specifically tracks a security. So it's a note that derives its value off of another security's value. And so VXX is the inverse to the S&P 500, and it'll track inverse movement. Anytime SPY traditionally is going, to the upside, then VIX should be trending downward, and vice versa. But a lot of times we'll see times where the movements between the two converge, and we'll see something where both VIX and SPY are trending higher. Well, why does that happen? VXX, and another thing to touch upon is the reason why we use VXX over VIX is just because of how liquid that fund is. It is one of the largest, and it's also the most liquid of them. So you can trade options in that fund and use that fund as hedging very easily, because there's a lot of volume, a lot of open interest in a lot of those contracts. Going back to my initial part about convergence between the two, when we're looking at trends between the S&P 500 and the volatility index, when we're looking at VXX here, VIX tends to be a leading indicator, and it tends to be leading, whereas SPY, for example, is lagging. And so a lot of times we'll see the volatility index start to move slightly faster or ahead of time in anticipation of movements to the S&P 500. And that really helps in the way the VXX is used as a hedge, right? A way to think of that is, as SPY approaches all-time highs, more people on a larger basis are going to hedge to protect themselves from any pullback from all-time high. And so that's one of those things that we'll see, is that while it normally trends inverse, we'll see that movement in high volatility scenarios where VXX is also trending in the same direction as SPY to the upside. And that might function as a warning sign. It might function as a indicator for you to add on some additional hedges to your account or something in that sense, if you do see them both moving to the upside at the same time.
Yeah, to go back to that market identifiers and how to keep track of them all day. Ever since we had that COVID crash, we all generally have to be a bit more cautious. So on all my watch lists, I tend to have them broken down by sector. I add SPY, VIX, VXX especially, and then UVXY to all of them. Every once in a while, I'll add in TLT as well, because treasury bonds usually have an inverse relationship with SPY as well. Except this past couple months where we saw them both rising at the same time, and then TLT just went off a cliff. But that was kind of expected. There's also other indicators you can look at. You can look at silver, precious metals, gold as well. If you see that the price of gold is skyrocketing, that usually means investors are prepping to hedge for an event, or we're reaching all-time highs and there's a lot of uncertainty in the market. So my recommendation would be just to have the big names on any watch list that you're looking at. So if I'm trading Tesla for the day, or Apple would be a better example. Apple almost trades with SPY coincidentally, they move together. So I would have Apple, SPY, VIX, and then UVXY all on my screen, and I'd be looking for patterns and just seeing what the inverse relationship is there, and how the effects carry from ticker to ticker.
Right. And that's one of those things, like I said, where SPY tends to be a little bit lagging, and we can kind of predict upcoming movements in SPY by looking at those other securities. For example, the reason why Apple and SPY tend to move hand in hand is because Apple is the largest holding and has the largest cap. So specifically, if we start to see volatile or fast movement in Apple, ahead of time, ahead of SPY having a reaction, then that might indicate to you some coming movement in SPY specifically, where, if Apple starts to move to the downside and VIX is moving slightly higher and there's no reaction yet in SPY, well, that would be a warning signal that you might need to watch out for some upcoming downside.
And it's something you'll see in the Discord almost every day. Jovan, Hovan, or Jovan will put out an alert, and he'll let you guys know that VIX is going up, it's going green, it's ramping, UVXY is ramping, and when we see moves like that, that's where it's important to kind of be on your toes, be cautious. Don't YOLO your whole account, and then you see VIX rising and you completely ignore it, because then that could usually be a bad outcome.
I absolutely agree. And so that's, it's something that you can easily track throughout the day. You can just kind of have that, like, like you said, either in all of your watch lists, or maybe if you're using a desktop platform, you could have it, on a small chart on the side. It's not going to be very intrusive, but it's going to provide you valuable insight into the market.
Yeah, that was actually a really good question. So thank you for that one. And then we got one more new one. How do you find sector rotation? So I'm sure you can drop some knowledge on this one, but for me, sector rotation is, there's a couple sectors that I trade frequently that I try to monitor. Travel being one, tech definitely being one, and then financials as well. So that's what your XLF, ETF. You look at JPM, Deutsche Bank is another one, Citigroup, things like that. If you see a lot of algo flow and open interest, volume, price momentum, price changes heading into those specific tickers, more than likely, if it's significant, you'll see it throughout that entire sector. I don't know of a way to time sector rotation. I don't think anyone can. I think it's more of a fundamental kind of news from what you see in the overall economic or market landscape. But what do you think?
Oh, well, it really depends on what type of sector rotation you're talking about. And so, I think earlier in the podcast, we talked a little bit more about a large scale sector rotation that's happening throughout the market on a, very long time frame, multiple days now, where, we do need the confirmation of a sector rotation to kind of support the market at this point in time, since tech is taking a breather. On a shorter term time frame, if you're looking at something, intraday, and you're trying to take a look at the flow, like you mentioned, and you're trying to see specifically what's happening maybe from one day to the next, a very easy way to keep track of sector rotation is, like you said, using any type of ETF that tracks a specific sector. And so you can have different ETFs on a watch list, right? Different funds, and you can track, the normal S&P 500, you can track, the Dow, the NASDAQ, whatever, but then you can also specifically have those different funds where you're tracking financials and you're tracking travel, you're tracking any type of retail or REITs or things like that. There are funds that you can add to your account and pay attention to the difference in these. And, specifically if you see SPY, for example, or, the market in general kind of starting to pull back, you see tech starting to pull back, where I might compare, how the financial market's doing to the tech market. And so that's a sector rotation that we've seen very frequently on a much more short-term intraday scale, where we'll see flow start to come in for banks, like you mentioned, when other large cap tech stocks like Apple and Amazon are starting to trend down. These banks will be green, right? There's flow into these banks, and that's part of the sector rotation. We'll see that money move on not only a short-term timescale, but also a long-term timescale too.
There's also, you brought up a good point with looking at some of the ETFs. Like, we all know that QQQ is what we use to track tech, but you can also look at, I guess, subsidiaries within tech. So if you're a big AMD, NVIDIA, Intel, MU guy, you can look at Soxel, SOXL. I believe that's based on all semiconductors. So that's another one that you can look at to kind of track the overall sector. Like we mentioned, XLF for finance. Having those ETFs on a specific watch list will definitely add value to your trading. Especially if you identify that, QQQ is ripping today, but then you look at a tech company that's not quite getting the volume that all the other ones are. That might be a point of interest for you to do some more DD, find out why, and could there be a potential setup there?
Absolutely, I agree. And so there's definitely a lot of information to be pulled from anytime you're looking at these funds and the relationship they're having with the individual stocks in the funds, right? And so that's something where we can kind of see how, QQQ or SPY is reacting as a whole, and then kind of pay attention to smaller reactions in, some of the cap stocks like Apple or Microsoft or Amazon, and kind of obtain expectations for them. And one of the things, one of the examples that you'll see happen there for a couple of weeks ago was when Apple was kind of leading all of our movement and had been kind of engaging in pumping our market to all-time high, but
Yeah.
we hadn't seen that same kind of movement in other tickers like Microsoft or Amazon, right? And so that's something where those tech companies are lagging in the price action that's Apple's initiating. And so we can kind of use that information, like you had mentioned specifically, to kind of obtain a sentiment towards, whether there'll be upcoming movement for those companies.
Yeah, I mean, I think that's a good indicator to look at, and then just one kind of a heads up that I think all traders should be weary to is we've talked about a ton of indicators today and how to identify potential setups and capitalize on opportunities, but you can get to a point where you are overloaded with information. That's why it's really good to have separate watch lists, and going into a week, don't try to look at every ticker or look at every sector. Identify one aspect of something you want to look at and go 100% into it. Because when you separate out your attention, you're going to miss a lot of the opportunities that have been right in front of you the whole time. So it's always good to have SPY, UVXY, VIX on your radar, and then have some of the major ETFs like XLF and QQQ on your watch list, because then you can use those to predict future price movements for those specific tech or finance companies that you'd want to trade. If you try to go into the trading day with just blindly looking at all the tickers, and Netflix is trading really high and they're going to go up, and I saw a news article, I would definitely just kind of just laser focus your vision on a few specific things. That way you can lock in those opportunities.
Absolutely, absolutely. And that's one of the things that we kind of, I think, touched a little bit upon when we were talking about our specific trading setups, is that for any beginner, you don't want to kind of overwhelm yourself with information or overwhelm yourself with really large watch lists. And, one of
Yeah.
these things I see a lot of beginners do, specifically when they take the classes, is that they'll have watch lists with maybe 20 to 30 different tickers on it. And you can't reasonably expect to be able to keep track of 20 to 30 different stocks unless you're a professional, unless you have
Yeah.
experience. So for beginners, like you just said, paring down to less information, focus more on the ones that you select is going to, help you in the long.
I mean, if you look at it, one of the first things that I did when I started trading is, of course, you got to download StockTwits and you got to download your Robinhood. But on StockTwits, they have a trending little section, right? You don't want to look into that trending section. You don't want to try to capitalize on something that's already trending. You want to try to capitalize on it before it starts to trend. I feel like a lot of those tools will lead you just to FOMO into something and end up losing money just based on IV, or you already missed the initial movement and then you hopped in right at profit taking, which I know it used to be a common issue that I used to have looking at it that way. That's why it's important to kind of identify a couple things you want to look at and just stick to the basics.
Absolutely. And that's one of those things that the more you practice that, the more familiar you get with a couple of specific tickers, the more able you are to predict upcoming movements because you're familiar with that price action already. You'll trade better by looking at the same stocks every day instead of trying to find out whatever's trending. And so that's like one of the things you said where, for example, Tesla's on my watch list every day and I'll look at it every day. But if I wasn't already paying attention to Tesla and I see it come up on stock twits or, some Twitter or something like that, or, Robinhood likes to send those in for little notifications where it's like Tesla's up 5% on the day, right? If I don't know any context, if I hadn't been looking at it prior to that, I might FOMO into a trade without any, foresight, any knowledge. And so that's something where you want to look at something, you want to get familiar with the stocks that you're trading to really help yourself.
Yeah, I agree, man. So what do you think about calling it a day for today?
Yeah, I think I think we touched upon a lot of topics. Obviously a lot of information as well, and I don't want to overwhelm, like we just said, everyone. So I think we can call it here. Take a break, regroup. Everyone who's still watching, thank you for tuning in. Definitely feel free to reach out to us. We're always around. Any questions, anything like that, we're trying to, make sure you guys are taken care of, make sure that we answer all of your questions. And anyone whose questions we didn't get to today, we'll try and get to it next time.
And even if we don't get to it next time, send us a message directly. I mean, we'd love to help you out in any way that you can. And yeah, this was fun. This was really cool.
Absolutely.
So submit some more questions for us, and we'll jump into it next Friday.
All right. Well, thanks everyone for spending a little bit of your Friday evening with us. We're going to sign off now and enjoy the rest of your night.
Absolutely. See you guys later.
All right. See you guys.